Hello everyone and welcome back to RJ Sanderson TV. Dave Kennedy here with Roy Sanderson. It's a sombre mood as we're all back in lockdown, the whole east coast of Australia it feels like, and there's spot fires everywhere erupting across the country unfortunately, but we're going to be here to discuss obviously all the news and financials, Roy, that is I suppose accompanying these COVID spot fires at the moment. Yes, it's strange times. Lockdown number 5 for Victoria and many other states going to lockdown as we speak. So, yes, we've got some facts and figures and it should be good. What's the general vibe from your clients at the moment in terms of lockdown 5, particularly in Victoria? How are they going with it? I think people are now used to working from home, so they've adjusted to that very quickly. I think the state government and federal government benefits have been announced. The payments that can be received by businesses and individuals are not yet up and running on their website, and they need to really get a hurry on that. But people are saying we've been here before and we know what we're doing. How do you think it is for people around Australia that haven't been into lockdown or hard lockdown like Victoria before, like people in Sydney as an example? I think they've probably learnt from Victoria. Around the state, I hear a lot of people saying in other states that Victoria did it right by they had hard and quick lockdowns, and some states haven't necessarily done it quite as hard and quite as quick, even though we within Victoria have been certainly critical of Uncle Dan for doing so hard and so quick, but it seems that it is keeping the numbers down. Let's get into some of our news headlines, and as we do each time, we're starting with some of our economic indicators. And one of the indicators that we use to look at the broad mentality around lockdown is consumer confidence. Now, these numbers, we must add, were aggregated during the week of 5 July to 9 July, so they're not necessarily indicative of the tight lockdown conditions in Victoria, and also they were conducted during that week, as I mentioned, when Sydney was locked down, but restrictions weren't as tight as they currently are. So we did see an uplift in consumer confidence. And this is one of our favourite stats for this show, Dave. We love to watch this one because it's an indication of what we're expecting for the future, the confidence. Interesting that it did go up a little bit, despite Sydney at the time being in lockdown. I think next month, with a lot more states in lockdown and Melbourne going into a second lockdown, I think we might see a little bit of a dip because we're still at very good highs compared to the history of this index. So it's still well over 100, so still good things. Another indicator that is quite interesting, particularly considering everything that's happened with lockdown, is the Australian stock market. So we've just ended another financial year, and I'll ask you about that in a sec, Roy, whether you had your 30 June countdown party as usual, but we've just ended the FY21 and you can see it's been another bumper year for the stock market. A terrific year, probably one of the best on records for some time, and despite all the little ups and downs, the trend has been up all year. We're going to talk more about shares with Tony Sarai later in the show, and we're also going to have a look at some of the increases in property prices nationally. But Roy, what do you think, are shares a better investment or property? Maybe don't answer that yet, actually. Why don't we save your answer for the end? We are going to save that for the end. We're going to talk a little bit about property today and a little bit about shares, and I'm going to give a conclusion on which is the better investment, shares or property. Speaking of shares, let's have a look at the 5-year chart for the Australian stock market, because we've seen the 1-year chart, it's well up. Now, you can see where the recoveries come from. This graph is quite extraordinary, isn't it? A, you would have made return on investment over 5 years on the stock market regardless, and B, you would have made significant return on investment if you invested at the bottom last year. And picking the bottom is very difficult. We don't necessarily tell people to try and pick the bottom. It's near impossible. The idea is to get into the market and stay in the market. Even if you actually purchase shares halfway down that slide, which was a very quick and sudden slide, you will be well up on what you invested in on the stock market. We're going to chat to Tony Sarai, as I mentioned, later in the show from RJS Wealth Management. The unemployment rate, the numbers hadn't been released the last time we spoke on RJ Sanderson TV. The new number is out, and you can see that the trend of downward unemployment rate is continuing. Again, another decrease in the unemployment rate, 4.9%. But beneath those numbers, Roy, it's interesting. They say that this is the 8th straight month of fall in the jobless rate and the lowest reading since June 2011. Part of that sounds fantastic. It sounds, the rate is great, but beneath the surface as well, there are still some issues in the labour market because there isn't a supply of labour that's coming in that we usually see. So the participation rate has remained the same.
It's very interesting that we look at low unemployment and we immediately smile and think it's a great thing. But at some point there's an optimum level of unemployment, and it's not zero, because right now at 4.9%, we are seeing clients with labour shortages. So it's starting to tell a little bit in the market because we don't have the overseas visitors.
Unemployment also doesn't represent underemployment as well, is another interesting shortcoming of the metric, because some people want to work full-time but are only able to obtain part-time work, and that means that they're therefore employed and not part of the unemployment rate. So there are some shortcomings. And to your point there, Roy, have a look at this one on job vacancies. We're seeing record high job vacancies. The number of job vacancies just continues to increase. And as you say, there are some industries experiencing skills shortages.
Yes, certainly some building industries, carpenters, certainly people out on farms, the hospitality. When hospitality is up and running and operating well, they can't get staff members because we don't have as many people visiting or travelling from overseas who would normally float through Australia from job to job, a couple of months here, a couple of months there. They're not filling those vacancies.
It's an interesting point. Another thing that we talk about a lot on this show is low interest rates. Now, we know that we're at historically low interest rates both here and overseas, so we won't show you that graph. But we are keeping a very close eye on inflation, Roy, and as the Australian core inflation rate shows, it hasn't really become an issue here in Australia as yet. You can see that the Australian inflation rate there at 1.1%, and the Reserve Bank has come out and said they're not going to increase interest rates for a number of years. The same is true in America, where the Federal Reserve over there has said, and that they took the lead on this by saying we are not going to increase interest rates for a number of years. Now, the Federal Reserve met earlier this month and started to backpedal in America, and some of the board members have started to say, oh, we may need to increase rates by 2023. We may need to increase rates before then. And have a look what's happened to the core inflation rate in the USA. It's skyrocketed. We're at 4.5% over there. And we know that the US economy is usually a leading indicator for what's to come in the Australian economy.
And in the US, they haven't had the lockdowns that we have had. But given our low inflation rate, given low labour, low unemployment, I think that we're going to see that turn around a little bit. And over the next couple of years, I think we're going to see inflation increase because it can't go anywhere else. All the factors point to an increase. Some
interesting notes on that US core inflation rate increase. It is the largest 12-month increase since the period ending November 1991, and well above the market expectation of 4%. And also, just an interesting note, just to give you context on the inflation rate. It's calculated through the CPI, which measures the cost differentials in a basket of goods across a range of sectors. Energy and food being two of them. In America, the energy index rose 24.5%. while the food index increased 2.4%. So we're seeing very varying scales of price increase across the basket of goods, which is leading to some pretty drastic movement in the inflation rate.
And right now, on the ground, our clients are experiencing price increases in building materials, especially items like timber, and a number of other items that go into a housing product. And I think that's going to have a huge impact. So we're going to see that over the next 3 to 6 months have an impact on our inflation rate.
And yeah, as you say, those supply shortages is going to be an interesting, interesting factor in this. So obviously on the demand side, the supply of cash is heavy, which increases aggregate demand and puts pressure on prices, but also pressure on prices through supply. So some interesting stuff ahead. Hey Roy, we've talked a lot about putting pressures on politicians, particularly you during Roy's rage. Sometimes you come off the long run there and really put some heat to the politicians. So I've been thinking during the week, it's time to put some heat and some pressure on you.
Let's do it.
Let's do question time here on RJ Sanderson TV, because we've had a number of viewers also write in some questions, so I want to put some of these questions to you. The first one is an interesting question. It's a term we hear a lot and it needs more clarification. What is wage theft?
Wage theft is a law that was created and became effective on the 1st of July 2021. And it is really, if you deliberately underpay a staff member, that is now classed as wage theft. And the penalties if you deliberately do this, for an individual, the fine is over $218,000 and potentially 10 years in jail. For a company, the fine is over $1,090,000. So wage theft, bear in mind, it's deliberately underpaying, not accidentally, but you would not want to deliberately underpay somebody now in Australia.
It kind of begs the question, why wasn't there a law in place before this? But obviously some pretty stiff penalties there for businesses and for companies. And
I think it came about because we had a very famous restaurateur, who we won't name, who underpaid staff. The argument was it was it was accidental, but they were never able to be 100% sure if it was accidental or at the core level, at bookkeeper level, whether it was deliberate. And that's why these laws are in, so that they can't do it and deliberately do it and get away with underpaying staff.
There you go. Well, you've done well with question one. Next question. Is the Victorian state government grant taxable income?
Good question. Now, there's many different grants. The state government grant had 3 stages to it. And those 2 grants, of the 3, the first 2 are actually not taxable. And the 3rd grant is taxable. We actually have a slide on this which shows which grants are taxable. On the left-hand side, JobKeeper, JobSeeker, and the first 2 state government grants are taxable. But rookie mistake for accountants out there, the state support grant number 3 is non-taxable, and also the cash flow boost is non-taxable. We did pick up a new client this year, and we picked up immediately last year his accountant had put cash flow boost down as income, and it's tax-free. So we've listed out the non-taxable grants there so people can see it. Rookie mistakes for those that get it wrong.
Question without notice, Roy. How come 2 parts of this is taxable and 1 part's not taxable? That seems very confusing.
What actually happened is I think the federal government and the state governments were talking about what should or shouldn't be taxable. So in between grant number 2 and grant number 3, they passed a law that said from now this type of grant will be tax-free. And when the grant number 3 got announced, it was after that law had been enacted, so it became tax-free. And that was a $10,000 grant. They were all between $5,000 and $10,000.
There you go. So a bit of a win there for punters out there on the state government grants.
Yes.
Question 3. I'm a tradie on wages and purchased a drop saw for $1,050. Can I claim this in full under the new instant asset write-off rule?
The instant asset write-off rules do not apply for people on wages. They actually apply to businesses. So in this case, because the tradie is on wages, he needs to depreciate that piece of equipment over time. Power tool is going to be 40% per year. But one of the things that he might have considered doing is talking to his boss about salary sacrificing the $1,000. So he drops his wage by $1,000. His boss goes out and buys the equipment on his behalf, and the boss gets to claim that as a full tax deduction because he's in business under the instant asset write-off rules, and the boss gets to claim the GST credit. So it's a win-win, and the worker saves tax on $1,000 by salary sacrificing.
Now, another question without notice. You know, you're a tradie and you potentially don't want to confuse your boss too much. How do you get them to agree to a salary sacrifice agreement like that and do it in a way that's simple enough for everyone to understand?
Well, I had this conversation with numerous businesses from time to time, and it's a case of talking to both of them so that they're both on the same wavelength and the boss understanding and the worker understanding it. So I think it's about involving the accountant to do a little bit of tax planning with the worker and with the boss. And I can tell you, the employer and the employee, it is a win-win situation.
Last question, Roy. You've done very well to this point. When people go to the accountant, what is the main thing they forget or get wrong?
The main item is working from home. We know in Victoria that we had a compulsory lockdown of 19 weeks. But that doesn't mean you only spent 19 weeks at home. What we need you to calculate the number of hours you worked at home. And although the lockdown was 19 weeks, you might have worked at home for 48 weeks or 52 weeks. But the key is to work out the number of hours you worked at home last financial year. The other item is if you work from home and that means you're wearing less uniforms, lower the amount you claim as laundry and cleaning of your work clothing. Normally you're allowed up to $150, but if you spend 6 months at home, then make sure you're not claiming the $450. And the tax office are looking at side hustles. If you have income from cryptocurrency, Airbnb, you have a lawnmower round and you're advertising on Facebook Marketplace or Airtasker, then those things will be known to the tax office. Make sure you include them. And the final tax tip is GoFundMe pages. They are not registered charities and not tax deductible. So you can't claim a GoFundMe page despite the fact that it might be for a very good cause.
Well done, Roy. You've done very well there with question time. And now the pressure goes from you to the broader politician community because it's time for Roy's Rage. What have you got for us today, Roy?
Well, two things that have really annoyed me, that has angered me. One of them was that there was a sole traders grant that the government handed out to sole traders. It was $3,000. The concept was good, but one of the conditions was that the sole trader actually had to be renting commercial premises somewhere. So all the sole traders working from home, they all missed out on the sole trader grant. That annoys me. Secondly, in Victoria and New South Wales, they recently announced a few days ago, a week or so ago, that there are benefits in this lockdown that we've just had, number 5 in Victoria. But you jump onto the website and try and make an application, there's no ability to do so. Let's get moving, people. The IT people need to get moving so that we can start applying for these grants that are available online and get the money back into our bank accounts because we're not working at the moment. We need to shift a little bit faster.
Yeah, that's a really interesting point. I think that as soon as JobKeeper and JobSeeker were put into play, you could see, as we've spoken about on this show a number of times, consumer confidence starts to go up. As soon as the money comes back in, and as we know, a strong level of consumer confidence is good, but sometimes it's not easy to make those applications, and the governments need to make sure that it is easy for people that are disadvantaged.
Agreed.
Roy, the theme of today is property versus the share market, and we're going to speak to Tony Sarai a little bit later on about the stock market, but let's have a look at some of the details or some of the price growth in the property market, thanks to some data from CoreLogic. What do you make of this, Roy?
This shows property price increases over the 12 months to the 30th of June. And they are, around Australia, it's been quite sensational. Now, I'm in Melbourne, Victoria, and I would have thought that we're a lot higher than that, but Sydney has outstripped Melbourne. It just shows that property has had a fantastic year, especially when we think back to when JobKeeper was invented, March 2000, and there was talk about the property market doom and gloom when JobKeeper was to finish, that property would fall off a cliff, and it just hasn't happened.
And we've got another slide here that also talks to some of the details there. We can see the Melbourne metropolitan increases. The big question is, Roy, we can always look at these historical charts and say, fantastic, historical, great growth. But the question is it sustainable and is it going to be continued? What's your thoughts on that matter?
I know when we talk stock market, share market, we can see wild growth diversions up and down. But in the property market, generally speaking, when we have property drop, it doesn't drop 20%. It's going to drop 2 or 3%. There will be some areas, high value areas, I'm talking Melbourne, might be Toorak, Camberwell, etc., that will drop more, but the general housing market doesn't drop by much. So I think property will continue to increase. I don't think it'll have the same value increase as what it's just had, but it will continue to increase.
Okay, well, there you go. Tony Sarai is from RJS Wealth Management, and he joins us today to talk more about the stock market. We've just heard about property. He's here to talk more about the stock market. Tony, welcome to RJ Sanderson TV.
Thanks for having me, David.
Tony, it's been another big year for investors in the stock market. Tell us about the last 12 months for those that have invested in the Australian stock market.
Well, it's been a fantastic 12 months where we've seen the share market hit all-time highs and we've seen some fantastic returns on the market. Those have been both from a growth perspective and we've also seen income and, dividends start to increase again as well, considering the year that we had prior to that.
Tony, given the record growth, is there any particular stocks that stand out that you go, this was a standout stock that you might not have thought it was going to be?
Oh, look, I would say that if you go back to February last year, there was no discrimination in terms of which stocks got hammered as part of the COVID. So the market dropped by 35%, and you saw I'll say across the board, there was red on the index. And since then, there's been recovery, and you've seen most of those companies recover. You've seen the banks do extremely well and recover extremely well. You saw, as an example, I'll just pick one off the top of my head. NAB got down to $14 and it's back up to $26. You saw CBA drop down to $58 and hit over $100 not too long ago. And you've seen, so they're the banks, but you've also seen BHP do extremely well. So the resource sector's done extremely well over that period of time as well. So there's been not one individual stock that's significantly outperformed, but you've seen a good recovery across the whole market.
You mentioned the banks, which is interesting because we had a Royal Commission some time back and some of the banks had fines and penalties in the millions that were hanging over their head, and the stocks started to drop because of that. Is that now gone, past, forgotten, or are there banks still with fines over their heads that we're aware of?
Westpac have just recently, they were hit with a fine not too long ago. I won't say it's been forgotten about. I think the banks have taken their medicine in terms of having to clean house and to reset and go back to basics. And that certainly had an impact from a profitability point of view. The other thing that impacted banks' profitability has been the lowering of interest rates, where rates have been cut, so they've got less room to manoeuvre in terms of profitability as well. So there's been those sorts of things, but going back to the question in relation to the Royal Commission, the banks have gone and taken their medicine, and they're still in the process of it. They're cleaning house. We've seen a number of the banks sell off businesses that are not key part of their banking or their core banking sector. So they're getting rid of those businesses and going back to basics.
Tony, you mentioned some price growth there from the bank stocks and a lot of blue chip stocks. What about for dividend investors? What's it been like for them this year?
It's been good. We're coming into the second half of this year where we'll actually see what profitability has been like for a lot of those businesses, and we would expect those dividends to increase in comparison to where dividends were cut for some, anywhere from 20, 30, 40%, and there were some that just did not pay a dividend last year. And we would expect a recovery because there's been a recovery in terms of pricing, but then we look at the broader economy as well, and I know we're in lockdown. However, in saying that, businesses are doing well. Companies like Wesfarmers, where you've got companies like Bunnings. If the minister says, "Oh, look, this needs to be done," you'll say, "Yep, I'm off to Bunnings." I'll be back in half an hour. You come back 3 hours later, spending 3 times as much. It's quite common. Whilst we're at home, we're spending a lot more on things like TV screens, computer equipment, because we are working from home. Lockdown is having that impact.
And just to that point, though, Tony, last year we saw that economic conditions were improving, and there was very strong demand for some of these products, but perhaps companies could use as an excuse the uncertainty of COVID and the situation not to return a dividend. Do you think that pressure is going to be mounting on them this year?
I don't think that'll be the case. I'd be very surprised if it does. Companies have had their chance to withhold dividends and to clean up shop. I'd be very surprised if that did happen. I don't think shareholders would welcome that, and we'd probably see the share price of companies go backwards as a result. Those companies have had the opportunity to be able to clean house. They should have done it by now, and set their business up for more success for this year and coming years. So I'd very much doubt that.
Tony, we've got a graph that goes back to 1900, so it's a long graph of each year's stock market movements. And I've noticed from that graph, just as when you look at it from a distance, that whenever we had a great year, like we've just had, often the next year or a couple of years later, it's quite low. It sort of evens out over time, or we have a small drop. What's the general forecasting out there for the increase over the 2022 year that we are seeing from banks and others?
Look, I'd say this. Your guess is as good as mine, as in what will happen. In relation to when we're looking at those graphs, we take into account what's happening in the economy. And one thing that is certainly happening in the economy at the moment is that people are better off today. And when they are better off, because we've got the lowest interest rates that we have ever seen. So people have more money. If you've kept your job, you have more money. You're not spending as much. So that trip that you'd planned to go overseas, well, you can't go overseas now, so therefore you have that cash flow available. Well, what do you do with it? Or if you've got money in the bank, you know that the bank isn't paying any interest. So what do you do with that money? Where do you find that return? And we've seen that movement of money go from bank accounts into the market or into property prices. We've seen that as well. So that's where we have had growth. Will that continue? Look, I think whilst we're in this low interest rate environment, I think we will continue at the same trajectory. Possibly not. We can't keep going at the same pace that we're going, and we'll start to smooth out over the course of the next few years. And even the RBA is saying that they're looking to raise rates in 2024. Things may happen before that, but we'll see.
Tony, one of the big questions we're asking today is, which is the better investment, share market or property? Where do you stand? What do you think? Not with a lot of detail, just where do you think the right answer is?
Look, for me, without going into too much detail, whenever you're looking to invest, you're either looking for either growth or income. That's the only reason why you would invest. So if you're looking from a growth perspective and ongoing growth, you can be very specific in relation to the share market, because you can look for growth companies. CSL as an example, or you could be very income specific and look for income producing assets, and you could say, well, okay, look, I'll pick the banks. So that being the case, I'd pick the share market over property at this point in time, and considering that the property prices have had a fantastic run in the last 2 years, and once again, can they keep going? Well, who knows? But you know that the profitability of companies will always be there. That's why they're in business. So those companies will go out and look at, well, what can we change from a technical point of view, or from an IT perspective, or and so on. And as a result of that, they can certainly look to increase their profitability, which at the end of the day should go back to shareholders.
Interesting food for thought there for our viewers. Tony, thanks so much for your time today on RJ Sanderson TV.
Thanks for having me, David. Thanks very much. Thanks, Roy.
Tony Sarai there from RJS Wealth Management. Roy, some interesting points. So Tony makes the point that businesses are always going to flourish regardless of the times, and I think that's an interesting point. We've seen, businesses like Zoom, as an example, have flourished during a COVID time where other businesses have really felt the effects of COVID. And you mentioned earlier in the show that property is perhaps levelled out slightly more. There's less big gains, but also less big losses. I'm going to put the heat on you now and ask that question that we've been trying to answer all show. Which is a better investment, stock market or property?
Now, before I give you the definitive answer, I will say that they are different. They're different animals. Property takes a long time to convert to cash. You can have rental problems. Share market will have ups and downs that you need to be able to cope with and be happy that you're going to read about it on the front page of a paper. So it takes different personalities. Property has bad investments, as does shares. So the long-term growth, when you look at since 1900 on property to shares, the growth in property is somewhere just under 8%, and the growth in shares is almost the same. So the answer is, it is a dead heat.
Oh, come on. Come on, Roy.
It's a dead heat. You should have a foot in both camps. And don't expect that one is always going to outperform the other, because if it did, and property was clearly a better investment, we would all be in property. If shares were clearly a better investment, we'd all be in shares. So they are about the same. And I'll tell you what comes third and last. It's cash investments when interest rates are so low. So skip that, but work towards property and shares.
I was about to start calling you Splinter Sanderson, but some definitive advice there towards the end that cash is not a good investment, which makes sense. Hey, Roy, that's pretty much all we've got time for today. Perhaps before we go, we're seeing, as we unfortunately mentioned off the top, that there's more and more places going into lockdown. Us Victorians, we've got a duty to the rest of our fellow Australians to help them through this time, because we've got experience in this space. What's your advice for businesses and for people around the country as they move into the unfortunate circumstances of a hard lockdown?
Well, for those in teams, workers, check in with your fellow workers. Do that by Zoom or phone calls. For those working with clients or customers, check in with your clients or customers, businesses who have to close and work from home, and make some regular contact, whether it's daily or every couple of days by phone, so that you can see that everybody's mental health is as good as it can be, and stay positive. There's only a timeline that we're having closed down, just got to get through it.
Here's some good advice, and hopefully not too long before everyone's vaccinated, we can go back to normal. Roy, thanks so much for joining me on RJ Sanderson TV. Enjoy the next month and as much as possible, and hopefully it's fruitful in other ways.
Thanks, Dave. It's been great, and we look forward to an exciting month, and we'll talk to you then.
Thanks so much to everyone watching RJ Sanderson TV. We'll see you next month.